Hi, this is Kevin from Excel Coach. In this series of recording, we'll explain financial statements. We'll break the recordings into multiple short videos to talk about a range of topics relating to financial statements. Before we continue, a small request. We'll appreciate your ongoing support by subscribing to our YouTube channel and Facebook page. This will ensure you get regular updates from us on financial literacy topics. For us, it means a lot as we grow our audience. Please click the like button and share any feedback or question you may have for us. So why do we need to understand financial statements? Whether you are a shareholder, investor, or just someone curious about financial literacy, understanding financial statements is a very useful skill set. Reading financial statements and interpreting them can be overwhelming. In this series of recordings, we'll break it down topic by topic so you are more confident in your financial acumen. We'll also use the annual reports from BHP, one of the largest mining companies in the world, to discuss real numbers. So what is the term financial statements about? Financial statements are effectively records of an organization that convey financial information. Some of the more common statements are the income statement, the balance sheet, and the cash flow statement. We'll go through each in detail. Before this, there are a few things and terminology for us to understand. The income statement. An income statement, also known as the profit and loss statement, shows the financial performance of an organization during a period of time. This could be for the 12 months ending June 2019 or December 2019, depending on the reporting period. The income statement records the revenue, expense, and ultimately shows the profit numbers. On the right hand side of my screen, we have the income statement for BHP. We have extracted the report from the company website. Almost all publicly listed companies will have their financial records readily available on their website. Other sources for this financial information could be Yahoo Finance or the stock exchange website. Let's understand the different sections of the income statement. While the presentation for each company can potentially be slightly different, by far and large, all companies will record their revenue or income in their income statement. As the name suggests, income is essentially revenue or gains recorded by a business. For example, BHP mines and sells iron ore, which is used in steel manufacturing. And the sale of iron ore will be recognized in the income statement as revenue. With expenses, using the example of BHP, think of it this way. To be able to sell the iron ore, a number of costs have to be incurred in the extraction and processing of a mineral to get it to the customers. Labor, shipping, administrative costs are examples of expenses. Many of us are interested in how profitable a company is. Profit is essentially the difference between income and expenses. There are different measures of profits. For example, profit before tax, profit after tax, EBIT, which stands for earnings before interest and tax, or EBITDA, earnings before interest, tax, depreciation, and amortization. With expenses, we have what we call cash and non-cash expenses. An example of a non-cash expense is depreciation. Let me explain to you what depreciation is. By definition, depreciation is a cost or allocation of an asset over its useful life. To mine the iron ore, BHP have some trucks which are assets for the company. Say at the start of financial year 2019, BHP bought a truck for $5 million. The entire $5 million is not recorded as an expense. This is because it is recorded as an asset, which I will explain in more detail later on. For now, just know that the full cost of an asset is not recorded in the income statement in 1 year. Instead, the allocation of an asset over its useful life is recorded in that income statement. This is what we call depreciation. It is a non-cash item. In this example, the truck is bought and $5 million of cash is used to buy it outright. Because a truck will be used for 5 years, the annual depreciation charge is $5 million divided by 5 years. This reflects that every year, BHP will be consuming $1 million of the truck. As you will note, every year BHP is not spending $1 million of cash. The original purchase of $5 million was one-off. That was a cash item. But the annual depreciation charge is not cash. Hence, we say depreciation is a non-cash item. Financial reports are prepared on the basis of accrual accounting. What does accrual accounting mean? With accrual accounting, it is not necessary for cash to have been paid before an expense is recognized or cash to be received for an income to be recorded. Okay? Say BHP uses contractors to work in the mines, and the contractors are paid 30 days after the month. If the contractors have done $10 million of work in the month of June, although they will be paid in July, the $10 million worth of contractor costs is recorded as an expense in the month of June. Accrual is when expenses have been incurred, not necessarily paid, or income has been earned and not necessarily received. Matching principle. What is it? Matching principles involve matching the income earned in a reporting period with expenses incurred. If BHP has recognized $30 million of income for the sale of iron ore in June, it is important that the associated expenses are also recorded. This ensures that the reporting of a robust and quality earnings number. It prevents companies from fiddling or massaging the numbers. In this recording, our objective was to explain the income statement to you. I trust you have found it useful. The next recording in this series will be on the balance sheet. Again, if you like our recordings, please subscribe to our YouTube channel and our Facebook page. Until next time, bye bye.